Okay, hi, good afternoon, everyone. Thanks for joining today's webinar. So the topic for today's webinar is about REITs, particularly from CSOP. So it's CSOP IH S-REITs Index ETF. Today, we're very happy to invite our speakers, Mr. Bruce Chang and also Mr. Raphael Goh from CSOP to give us this webinar. Just a bit of background about Mr. Bruce Chang. Mr. Bruce Chang is the head of fixed income at CSOP Asset Management. He's also responsible for the portfolio management of bonds, REITs, and money market investment strategies. And before that, Mr. Bruce worked at State Street Global Advisors and held several roles, including product engineer, portfolio specialist, and portfolio manager. He was also responsible for managing billions of fixed income portfolio across multiple sectors. Okay, so I will hand it over to Bruce and Raphael.
Thanks, Philip, again to invite us to this lunch webinar, and thanks everyone for attending during the lunchtime. So today, my topic is still about our S-REIT leaders index ETF and S-REIT's performance on the back of the higher for longer interest rate environment. I think a lot of Singapore investors may be interested in this. So 10 days ago, actually, our investment advisor shared a similar outlook in a physical event with Philips. And looking back to the last year, there are more headwinds than tailwinds for S-REITs, such as cost, monetary policy, and also the spread. But on a positive note, the rental reversion and occupancy stay resilient, with the occupancy cost still manageable. We think this is particularly true to the S-REITs because the majority of their exposure are still in Singapore, more than 50%. And as for the Singapore growth this year, despite some bumpy rebound, the manufacturing PMI did see some improvement. And in the meantime, the Singapore core inflation, as shown on the right-hand side, is cooling, which is also a good sign for the S-REIT's operating cost. And in terms of the SGD impact, the SGD strength, or Sing dollar strength, it's a headwinds to S-REITs because it implies lower overseas revenue, particularly for those REITs with a more international exposure. But these could turn to a tailwind once the inflation subsidies and the US, when the US start to cut rates. Of course, this may not happen in the short term, but it can still happen in the middle term, such as late this year or early next year. And more specifically to the sector outlook, starting from the industrial S-REITs, it seems most of their supply and demand are still manageable, except for some business parks. It means despite some increasing supply, the demand is still there to match it. And from a fundamental perspective, all the major industrial REIT names had the positive rental reversions back to the 4Q last year, and also with a positive guidance this year. And the demand also exists in the data centers with a nearly full utilization, a 99% utilization, with a limited supply, thanks to the digitalization and AI boom. And also another positive development that as the build restriction is a bit relaxed in Singapore since last year, the upcoming supply will help match the rising demand. And also moving to the office REITs, as the grade A office supply is just concentrated in a few buildings, as you can see here, the Central Boulevard Tower or some Show Tower, then the net new supply is not an immediate risk for this sector. And also, we notified that some tech or Chinese leasing demand, they wanes, that's for sure. But again, for wealth, legal, finance, or insurance, they have to benefit from the credit demand bottoming and also the regrowth. And more importantly, the flight to quality, the flight to green, and relocation cost concerns, they still benefit the S-REIT office rate retention ratios, particularly for those CBD grade A offices. So that's why the largest S-REITs can still see some double-digit positive rental reversions here. And comparatively, the US, UK, or Australia offices, they still impacted by the work from home, the norm. So it's not quite exciting, but the Singapore office rates are quite okay. And in terms of the retail rates, it is interesting to note, despite the shopper traffic being still below the pre-COVID levels, the retail sales have far exceeded. This reflects the impact of the inflation. And future recovery in terms of the volume will therefore boost the sales further. And downtown malls are seeing a stronger performance than the suburban malls back to last year, given that more inbound tourists and outbound residents. So tourist recovery should continue to be boosted by the strong pipeline of the MICE events and the sell-out concerts earlier this year. And these events will continue to support tourism and downtown retail sector for the S-REITs. And as a result, the CBD leasing are still quite strong on retailers' confidence in tourism recovery, and back to and also because of the return of the office crowds and also the new Chinese related retailers. The strong rental reversions are because of the typical 3-year leases that are being renewed for now. They did as they used to, but they used to renew during the COVID impact period. But now the rents are also inflating, so that's why the rents are much higher than before the periods. And similarly to other sectors, the limited supply will further boost the whole the retail sector. The tourism flow not only impacts the retail rates, but more directly drive the hotel rates. And after reopening, the Singapore visitor arrivals hit 13.6 million in 2023, and it is back to reach around 15 to 16 million this year. So from occupancy perspective, they may still get some support. But if you look at this page, from a RevPAR revenue per available room perspective, we still see some headwinds, such as the high base effects and the easing of this revenge travel, because Singapore is the relatively early bird in terms of the reopening. So these kind of factors already led to some RevPAR decline from its previous peak. But of course, this is not a Singapore specific, and some of our key hotel rate holdings, they still manage to report improvements, RevPAR improvements even versus the pre-COVID levels. And given that, as shown on the bottom left chart, the Singapore hotel pipelines are still very, very limited in the upcoming 1 or 2 years. The hotel sector should still be okay. And page 15 lists our major S-REIT holdings of 4Q23 rental reversion, together with their reversion outlook, and most of them can still deliver a good growth for this year. And in the meantime, from an operating cost perspective, we can see that they are still relatively under control. Thanks to the easing wage growth, or less tight labor market, as well as the lower average Singapore electricity price. And also the S-REITs have been passing some of these costs through the higher services charges and rents, which means if inflation is trending down, then the operating costs will be trending down. But if inflation is sticky, then at least for the S-REIT leading names, they can find a way to pass this through to the customers. And again, interest rate, still the headline, remains the key concerns for the S-REIT's performance in the next couple of years, but it's also act as a double-edged sword, which means if sometime it can finally make a turn, it also can be the most compelling driver for the S-REIT's price to regain its power. But at the current stage, since the rates went up a lot over the past 2 years, the borrowing costs have expanded by over 100 bips on the back of the higher interest rate environment. And looking into this year, 2024, on the back of the sticky interest rate environment, the 2024 borrowing costs are likely to peak out by rising another 0 to 50 bips as the cheaper debt also roll over. And on a positive note, the implication here is, well, any immediate cut is unlikely. There's also no expectation for further hike of the interest rate. So at least we have a ceiling of the policy rate. And despite the higher borrowing cost, the leading S-REITs are gearing. They have been well contained, still well below this 45%, thanks to the rental growth and the Singapore relatively stable Singapore cap rate. This means most S-REITs they still have some revaluation buffers before reaching the MAS regulatory 45% gearing, so they can continue to develop their projects by increasing the leverage a bit. So let me try to put it full screen if it's okay. So you see a full screen now? Yeah, it's good. No, not full screen. Okay, let me try to do a PDF version. Sorry, I'll do a PDF version so that you can see an even larger screen to see the information. It may take a bit time, 1 or 2 minutes. Sorry. Let me do this again. Let me reshare this PDF version. Please wait for a while. So now I believe you can see the full screen, right? The full screen of this the whole PPT. Then we can continue. So since we are mentioning the gearing, we can see that here we still have some buffer, so to further develop their projects by leverage, and also the widening yield spreads versus the cap rates, the relative stable cap rates, are still conducive to the interest rate coverage ratio, the distribution per unit, as well as the acquisition growth. And specific to different sectors, the Singapore industrial, logistics, business parks, and as well as data centers, they are still accretive, which means their yield are still higher than the cap rate. And in the meantime, retail REITs and hotel REITs are relatively neutral. And but in the meantime, the office is a bit dilutive, which means their yield still below this cap rate, which means which may also impact their further acquisition moves. But overall speaking, as compared to last year, this year, we definitely see more tailwinds than headwinds. Inflation is cooling down, the operation cost is declining, though the borrowing cost still has some room to go higher before finally reaching its peak later this year. But it seems that at least the monetary tightening this already peaked in the United States. And in the last section, I will talk about from the valuation angle, because from a valuation perspective, the S-REIT yield versus the risk-free rate, which is the Singapore 10-year bond, they still looks a bit tight, just above 3%, 350 bips, but it's becoming more and more fair, because if we do a scatter plot chart to compare the yield spread as well as the risk-free yield, we will see that March end this year March end valuation is quite fair and in line with the historical average as shown in the dotted line. And more interestingly, it seems S-REIT are undervalued given the 0.85 multiples price to book level. These may trigger even stronger rebound if the sentiment are coming back. And in my last page, I want to highlight that the CSOP Edge S-REIT Leaders Index ETF, the ticker SRT in Sing dollar or SRU in US dollar, listed on SGX. After listing, despite the higher interest rate, we managed to maintain a stable AUM, currently around 70 million size, and decent dividend payout. And our most recent dividend yield is around 6.5% per on an annualized basis, which is higher than the index yield. And our next half-year payment is scheduled to be announced in July or to be paid in August. As the current index yield it's around 6.4%, so we continue to expect a potential decent payout next round. So in short, if the Fed stays high for longer, the investors can still realize its gain through the decent cash dividend payout, which is roughly 6% for ETF in the 2.5 years history. And if the Fed finally turns dovish later this year or next year, then the capital gain potential can be huge by holding this ETF because the S-REITs are still 20% off from its previous peak. So I will pause here and to see if Ralph would like to add more colors, and also we welcome any questions during this lunch webinar. Thanks.
All right, thanks, Bruce. Yeah, so I think at this current juncture, a lot when we participated in the Philip Securities stock pick event recently, we received a lot of key queries from end clients. Is that, hey, actually, there's a few REITs ETF listed on the SGX markets. Why should we pick your CSOP IHS REIT Leaders Index ETF? So I think on the back of this, the answer is simple. For us, our ETF is slightly different from the rest. Traditionally, certain indexes may assign a higher weightage to the higher market cap companies pertaining to that. But however, for our CSOP IH S-REIT Leaders Index ETF, we adopt a different methodology. For us, it's more on the liquidity, daily traded velocity adjustment that we assign this weightage. So first of all, on the universal selection criteria, we only incorporate the large and mid-cap S-REITs ETF. So minimally, the size of these large and mid-cap S-REITs has to be at least of 500 million Sing dollars in terms of market cap. Ultimately, following the weightage assignment will be based on the average daily traded velocity during each rebalancing phase. So what this actually means for end investors is that any point of time after the rebalancing phase, your portfolio will be in line with the market current conditions. So for instance, if certain institutions were to exit or enter certain positions, this will be adopted and also traced on a quarterly basis, and then all this will be incorporated in it. And then with respect to that, once you track the daily traded velocity, what it actually gets is that you track the inflows and outflows. So after each rebalancing phase, your portfolio will be in line with the current market expectations, or at least the expectations of these large institutions' movements. So on top of that, we would like to just reiterate that the management fees, we understand that most clients are a bit particular about the fees portion. So nonetheless, we cap the total expense ratio at 0.6% per annum. And on top of that, I just want to highlight for our ETF, right? So actually, Bruce himself, he is the portfolio manager of our CSOP IHS REIT Leaders Index ETF. And on top of that, due to his active participation in these corporate actions and also our traders' due diligence in avoiding slippage. In fact, our ETF outperformed the benchmark index itself.
Yeah, I think thanks for Raphael's colors. I think what I want to highlight that, of course, we have a 0.5% management fee and capped TR at 0.6%, which is quite similar to our peers in Singapore. But just as Ralph mentioned, is that through the ETF tax efficiency as well as the corporate action participation, in the history since our ETF inception, we did outperform the benchmark by even, and this outperformance is even more than this TR level, which means investors no need to that don't need to worry too much about these TER to pay it to these to the ETF. And also more importantly is that invest through this ETF, investor can save a lot of potential trading costs. Of course, investor can can trade these large S-REITs on exchange, but our ETF has a very has a good edge in terms of these trading costs, both on exchange or off exchange. On exchange, we do have a relatively lower beta spread than direct investment, and if you investors choose to primary trade, create shares or redeem shares, starting also not starting from a very high units, just 50,000 units or roughly slightly more than the 40,000 SGD. So we can even achieve a very low cost because our underlying S-REIT trading can do market on close pricing with very limited commissions. So that's why we can translate or transfer these cost saving back to the end investors. So investors can benefit from both the ETF historical performance as well as the trading cost saving. And again, although this is a passive ETF replicating the benchmark, we do have the Shore Capital, which is the property experts as our investment advisor. So the investors can enjoy an active service through paying a passive fees.
So we'll just take 1 or 2 minutes to see if there's any questions on the floor. Just feel free to type inside the chat box. See if you have any concerns on the REITs, S-REITs itself in particular, you can just let us know. We'll just be here to answer some of your questions.
Yeah. In the meantime, what I like to say is that we definitely are still in a high for longer environment and can be even longer for this period. And the implication here is that you may argue that the US stock may still have a good positioning, even their valuation expensive. But S-REITs as compared to stocks or bonds, they are in a very unique position, because as compared to the stock universe, the S-REITs, they are relatively defensive because their rental their rents typically have contract typically 3-5 years or even longer periods. They can provide a cushion even the market is volatile or even the growth picture is uncertain. And so that's why the S-REITs or REITs, they have a lower volatility versus the stock market. But in the meantime, as compared to a bond market, let's say if we are in a high for long environment, then the bond market may continue to suffer because the price is a natural reflection of a high yield, because the price may still be lower. But as compared to the bond investment, the REITs, particularly for S-REITs, they have a growth component because of their stable dividend, also their AEI, as well as their acquisition move, which means as compared to the fixed income, pure fixed income sector, they do have a growth component. So which means even the market is still uncertain in the future, investors can anyway still a very stable dividend payout. But if the market turns more friendly, then investors may receive up to double-digit or even 20% capital gain potential in the next couple of years when the Fed finally start to cut.
So let's see if there's any questions. If there's no questions, we'll hand over the time back to Daniel. Daniel, are you there?
So something in chat. Oh. Yes.
All right. So
Yeah.
if there's no further questions, just feel free, or some of you are very shy, just feel free to drop the Marine Parade branch an email, and then they will send it over. Oh, yes, that's
Yeah. we are happy to work with the every end investors, and also we really appreciate the Philip's help both through these physical and online events, because we do see, even we see some high for long environment in recent weeks. We do see some inflows into these ETF, which means investors are still like these high dividend payout products, and also can be prepared for these the future capital gain, because anyway we gradually see a ceiling of the interest rate, because this inflation control is on its way. But now we still have a lot of room for the future upside. So that's why I think we think this is a good time for investors to embrace for these ETF, particularly through these Philips platform.
Hey,
Thanks.
Bruce, there's a question. So I saw
Oh.
currently, is there any PRC properties exposure inside?
That's what I want to tell. Yeah, in fact, we don't have any direct exposure to C-REITs, whether they are listed in China or whether they are listed in Singapore. But we do have a very small exposure through the S-REITs, the SGX listed REITs, through their underlying exposure. For example, the CLCT, the CapitaLand China. But it's interesting to note that even China is under some growth pressure starting from 2 years ago. There are still some green shoots, particularly for the service-related consumption, or the so-called revenge spending, which means even the big ticket item spending, they are still under pressure. But in terms of these restaurant spending, in terms of these cinema ticket sales, or even in terms of the domestic tourism, they're still quite strong. And these parts can directly support the S-REITs exposure linked to the China. And also, more importantly, is that for the S-REITs initiatives in China in recent years, they start to diversify their business from the commercial REITs, let's say the malls or the offices, to the industrial REITs, such as the logistic related REITs and the data centers. So they're not simply a cyclical related place, but more becomes more diversified, defensive. Even on the back of the China's growth pressure, those REITs may not necessarily be hurt from those headwinds. And more importantly, these also accounts a very small exposure in our portfolio, just around 5% or less. So that's a very important part.
Okay, so the other next question I have, I saw that how are we able to check the composite portfolio as real-time as close as possible? Yeah, so with regards to this, actually, the information is published on our website. The rolling 1 year tracking error is at 0.23%, and the tracking difference is at only 0.06%. So yeah, you can see how active Bruce is with regards to handling some of these corporate actions from the underlying portfolio, and also we try to hug the benchmark as closely as possible.
Yeah, we fully replicating the underlying benchmark, which means the tracking error will always be tight. But on the top of that, we can leverage corporate actions and leverage tax efficiency to outperform the benchmark a bit, even we are passively managed ETF. That's why, as I mentioned, investors pay some TERs, but in the history, since inception, we can outperform the whole TER. Even net of the TER, we are still, net of fees, we are still slightly outperform the benchmark. So this can definitely benefit the investors to use an ETF vehicle instead of the direct investment.
So the last question we see is that Maple Tree Pan Asia seems to be in bad shape currently. Is this currently in the portfolio?
Yeah, MPACT is in our portfolio. I didn't think I put it here, but again, what I want to highlight is that when we choose the underlying S-REITs, it is strictly based on the rule-based methodology, which means the S-REITs with a larger market cap, together with the better liquidity, will have a position in the portfolio, will have a higher weights, and through the semi-annual rebalancing, the S-REITs with a better fundamental, better liquidity, larger market weights will naturally see larger weights or be even included in the portfolio. And those are relatively speaking, those losers may see a relatively smaller weight or even be excluded from this benchmark. So the implication of these market cap or liquidity weighting through these semi-annual rebalancing, they actually imply a sector rotation or a winner rotation logic. For example, for now, we have some cyclical names like the retail, office, and also the hotel rates, but we have even higher rates in terms of these logistics, industrial and the data center rates, which are benefiting from the current Internet of Things as well as the AI boom. Well, I think this is a particularly exciting part for the current portfolio.
Right, so we'll just wait a last minute to see if anyone last question for the ground. If not, thank you so much for taking your lunchtime off to sit in with us on this S-REITs updates. And also, just for info, actually, our CSOP IH S-REIT Leaders Index ETF, it's also on Phillip Securities Share Builders Plan. So if you are looking to build a portfolio of REITs and also to accumulate over time, do consider on subscribing through their SBP platform. And if you have any queries, just feel free to drop the Marine Parade team an email. So if not, I'll hand over back the time to Daniel.
Thank you, Raphael and Bruce, for this wonderful presentation. So if any more questions, do drop us an email. Our email is marineparade@phillip.com.sg. Okay, so with that, we shall end our webinar now. Thank you everyone for joining in. Thank you.
Record.